This week on Sylvia's Traders Lounge.
So don't be afraid to step back and look and see what the heck happened back into the chart, because that's going to be really reflective of where the price may be going.
Sylvia's Traders Lounge welcomes you all to yet another webinar where we learn, trade, and profit. We shall be giving you trading insights on technical analysis, fundamental analysis, risk management, and trading psychology.
All right. It's truly an honor to have you back again on our trading lounge. Anka, we've had like sessions with her in the past, and she's really good at teaching us what she knows to do with trading, forex, stocks, everything. She does everything. So we welcome everyone. Thank you, Travers, for joining us. Thank you, Kish. So we'll just start. Maybe Anka, just tell us how your trading has evolved since COVID, because I think that's the last time we spoke. Yeah, in 2020 or 2021. Yeah, 2020. Yeah.
Yeah, 2020. It's hard to believe that it has been already 2 years. So thank you so much, Sylvia, for having me back on your show. Always such a great pleasure to be with you guys. I just love these shows. And how trading has changed. Well, I would say that if there is something, it has taught us to be a little bit more patient and very aware of where the market may be moving and what the market may be, how the market may be reacting. So I think one of the big lessons from 2020 was patience. There was definitely a lot of money that was made into the market in 2020, even though in 2021 we had a perfect trending year. So basically we had that black swan event that took the price lower of February and March, and then from March on we have been rallying since the beginning of this year. In fact, since the first couple of days of 2022, it was a very impressive rally, and now we've developed a little bit of a downtrend. So I guess the one thing that taught us is, I would say, two things: patience and sticking to the trend. And I think it's so important to stick to the trend. So you stay with the trend as long as the trend carries you through your targets, and as long as it doesn't work anymore, I guess you have to change the tune. So yeah.
All right. And did you also fall into the crypto bandwagon for many people during that time? Or did you stick to your asset classes, the ones that you've been trading, the normal stocks, forex, commodities, and whatnot?
I am very conservative, so I have not dabbed into cryptos, even though, they have been very tempting. And to be very honest, I did look at them, I did analyze them, but I found that it was rather complicated, very complicated to open an account and to actually, start executing trades. And I was really a bit insecure about, the wallet and all that stuff. So, you know what, I just had to stick with something that I know that is working for me. So I trade stocks, and I trade definitely commodities, I trade currencies, and obviously futures, what I do for a living every single day. So that's for income. Yeah.
All right, so Kish will ask her question, then we'll dive into like your live trading examples. You can take us through the most recent ones that you're looking at, and also for tomorrow being NFP, what you would be looking at when it comes to currencies. Yeah.
Okay, so what are the riskiest decisions you've made in your trading career so far?
Oh, okay. Can you repeat the question? Because you're a little bit far from the microphone. I just tuned it up a little bit.
What are some of the riskiest decisions you've made in your trading career so far?
I'm glad that you asked that question about risk, because it's very often that I teach my traders, once in a while, as they're joining my trading room or as they're joining my classes. This is actually something that we start with: risk. Risk should be the same. So I am not risking more or less on any trades. Basically, risk should be something that should be religiously followed. So for example, if you have a certain account size, I would suggest traders that are at the beginner stage to risk 1% or even less per trade, and traders that are a little bit more advanced, that have achieved consistency, that have a really good plan, follow their plan, they should definitely go for 2 to 3%. For example, if you want to grow your account, it's easier to grow it with 1% than at the beginner stage, then, you know, risk 3%. Think about it, you know, like if you have a certain account size for and then you know, if you risk a lot, 10% on the trade, that's literally almost, you know, 1%. That's literally a lot compared to the 1%, and it'll take you through your whole entire account very easily. So you would basically blow up your account super fast. So where if you start on the slow route and position size appropriately, then that is going to keep you in the game for a very long time, and you're less likely to blow up your account. In fact, it makes it impossible for you to blow up your account. And that's, I think, one of the most important things that traders should learn right from the beginning of their traders development stage.
All right, so I'm gonna give you access to share screen, Anka,
Okay.
and then you can take us through your live trading examples, what you're looking at, what you have been trading so far.
Okay, absolutely. Let me just get the screen share right over here on this side.
All
I'm
right.
using a different computer to share. So
No
I hope
worries.
that's
Okay.
all right. So let me know if you guys can see the screen.
Yeah, we can. Yeah.
Okay, perfect. All right. So basically what I do every morning is because I trade futures, and I trade the 4 indices. I trade the E-mini Dow, the E-mini S&P, E-mini NASDAQ, and E-mini Russell. And I focus on commodities as well, but more into the swing side than to the day trading side. But obviously, if the price action is right, yes, I do like to trade gold. I do like to trade oil, bonds even. I actually have a swing trade that I'm going to show you guys, share with you guys in silver, copper, agricultural products, etc. So those are for swing trading purposes. But for example, I only trade 2 hours or less. Some days are more generous and we're done in probably 15 to 20 minutes or 30 minutes. And in some days, you know, we have to stick on a little longer because the trend has been, you know, sideways, or is not proving a directional bias. Or like yesterday, we were waiting for Federal Chair Powell to speak, and that came at 12 o'clock. And it's reflected on the technical charts, and in which you have to be a little bit more humble and you have to go for smaller targets, and where the price action is a little bit more choppier. But definitely what I do is I start my analysis definitely with higher time frames. So I sometimes go out at beginning of the month. For example, like now I go onto the monthly chart because it's so important to take a dive into, to zoom out and to take a dive into higher time frames. Higher time frames are going to give us the dominant trends, the dominant action into the market. So if we look, let me just take this out here. All right, for example, this is the Dow. I could pick up like any index, but I'm just going to walk you through because this is what I had on my charts. So if you take a step back and if you look at this chart, we have had a really massive uptrend since forever, so if we go back in time, you could see that we could go as far as 2008, as far as 2020, right? Even though we had the financial crisis, the dot-com bubble, we had some turbulence along the way, and I'm going to show those turbulences in a second. But the reason why I look at a very high time frame, and especially today, December 1st. So happy December 1st, everybody. It's the last day of the year, and it's definitely the last trading day of the year. So that's very important for our technical charts, because we're getting brand new candles today on the monthly chart. And guess what? At the end of this month, we're going to be getting brand new quarterly charts, brand new quarterly candlesticks, I should say. So that's why it's so important to look at these, because you get the patterns, you get the formations, you get the candlesticks that are lighting up the way for future price action. So it's giving you kind of like, it's sort of like having the crystal ball, and it's giving you a little bit of idea of what the price action may be doing technically. So basically, when we're getting news is just a brief interruption in the trend. So it's not that relevant for a longer term trade or for a longer term trend, because longer term trends seem to digest the price action. So that's why they become irrelevant when you're looking at them. Because even if you look at this chart, this is the monthly chart, and this is the E-mini Dow, you're seeing that the trend is intact. You could see here that we still have higher highs, we still have higher lows. We definitely created this confirmation in the month of October, where we rotated back to the upside, and also we continued higher throughout the month of November. So we showed that so far the first 2 months of this quarter have been progressively going higher, and therefore, you know what they say, an object in motion tends to stay in motion. Then the directional bias should be higher ongoing for December. Now, December has a different vibe before we actually dive into trading, because there are a lot of things that are happening in December that are not happening literally throughout the year. One thing that is common to happen every quarter, for example, because we're talking about indices, is the fact that we have the contract roll that is coming into the first, I believe, the first week at the end. This is the first week. So it's coming next week. So next week we have the contract roll. This contract will be moving into the March contract, because we're still trading the December contract. So that creates volatility, that creates divergency sometimes into the market, and that can be seen not only in the futures indices, but can be seen in the major ETFs, the Qs, the SPYs, the diamonds, and Russell. So it's it involves the stock market. It literally wraps up the volatility, and we're getting a lot more choppiness as we're going into that. So that is an effect that takes about 6 days, 3 days before and 3 days after the event. So now that we're done with that, guess what? We're getting into the quadruple witching option expiration, which is coming once every third quarter. And this is very important for the technical pattern, because we need to be aware of these phenomena before we actually look at the technical charts. So quadruple witching option expiration is third Friday of every single month, and it's just a roller coaster ride. Typically, the market remains sideways, and as you're getting closer to the quadruple witching option expiration, the price action starts to gyrate really big, in a big way. It's a roller coaster. So they're driving the market higher, they're driving the market lower, and then they're kind of fizzling out. So they're flatlining it. And this is just to kill the premiums out there. And that is for options traders. And there's another phenomenon that is happening right after that, and that is the Santa Claus rally, because we're getting closer and closer to the Santa Claus rally. And believe it or not, we have had Santa Claus rallies every year. Even in 2020, we did have Santa Claus rally. We had some volatility in 2018 that I'm going to show in a little bit. We had Santa Claus rally that came in on the 26th, just a day after Christmas. So we did have the Santa Claus rally. We're expecting Santa Claus rally this year, especially with these kind of setups that we're having in the market on a macro level, higher time frames, monthly charts, quarterly charts. We're expecting the trend to continue. We have very few stocks that are remaining to report earnings, so we're not going to have a lot of impact from the fundamental side. It's just now we're going to have to wait and see how the news side is going to handle this, and how the news side, it's going to be a news driven market in December. And we have a FOMC meeting as well at the end of December. And then wait, but there's more. Towards the end of December, we have the window dressing. This is a phenomenon that is happening at the end of each quarter, where portfolio managers are trying to look smart, so they're dressing up their portfolio. Basically what they're doing is they're getting rid of the stocks that have been underperforming into their portfolio, and they're jumping into high-flying stocks. So for example, if there's a portfolio manager, let's say, that has been holding, I don't know, let's say Apple, right? And Apple hasn't been performing that well. They're ditching Apple and they're jumping into, for example, Boeing or something that has, or let's say Johnson & Johnson, something that has been rallying throughout this whole entire year. And generally stocks that are making yearly highs, 52-week highs, as we're getting into the end of the year. All right, so now that I, kind of like did a little introduction about what I'm looking for the month of December, let's take it to charts. Let's take it to charts and let's see what we have going on. And did I mention the FOMC? Yeah, Powell, right? So the FOMC decision again, right? So we're gonna have to wait and see how that is gonna play out. Okay, that was a mouthful to start with, but now let's see, take a quick look at the technical charts and see what we have, right? So we talked about this continuation. This is the rotational point that took the price higher. We traded actually above this level of resistance that we had from the month of August. So we have erased the summer and we have erased the fall losses at this point. And we closed very strong yesterday. Of course, yesterday we were helped by Powell again. So basically the market was helped by it. But for those of us that are trend traders, this was amazing because it took our prices higher for stocks and took our prices higher for indices, for day trades, for swing trades, and for our investments. So if you look at the macro level, we had a big push here. This is the pandemic pullback. And this is the high that we had in January 3rd. And then we pulled back to the 50 SMA. I'm using just a few moving averages here, nothing very sophisticated. You're not going to see any sophisticated indicators on my charts. I'm basically like an old school trader. So this is the 50 simple moving average. I use the 20 simple moving average, and the accelerated trend line right here is the 10 exponential moving average. So basically the price action did a really great job for us traders because it has cleared the path. So it's trading outside of the moving averages. When price is trading outside of the moving averages, we know that the price action should be bullish and we should trade into that specific directional bias. Price is below the moving averages, we should be bearish. Price above, we should be bullish. All right, so here we have it. So we closed the month with the high of 34,647. Now this overnight price action took the price to 640. So it's just like borderline into triggering higher. It's just waiting for a confirmation. And again, it's just the first day, but the way it's setting up is setting up for a continuation back up into the 3,500 to 3,600. So we can expect the price action to progress a little bit higher. It seems that the market is digesting this whole inflation thing, the war, everything is kind of like, has already gotten used to it. So the next move that we're seeing in the market is for the upside. Now, I promised you guys that we're going to show you something very interesting here. So let me see if I could, let's just switch to the mini S&P because that is a better representation of the market. Okay, which pretty much has the same chart, right? They're all trending. The reality was that the Dow actually is the super performer of the year. The S&P is lagging a little bit, NASDAQ definitely lagging, and so was Russell. Russell's still lagging, but the Dow was the bigger performance. It has stocks under it like Caterpillar, Boeing that have been performing really well. But anyways, I think the S&P is a better representation of the market. It has 500 stocks under it versus Dow, which has only 30. So here's what I'm looking at. So what I'm going to do here, I'm going to give it a little bit more time. And we're going to go on to a really interesting, oops, sorry. Let's keep it on the monthly. All right, let's give it maximum time that we have. All right. So here we have, we're not interested in candlesticks right now, but we're interested in the directional bias and where we're going. So do you guys remember, if you have been trading in 2020, I have, or in 2020, 2028, I have, these were the events that shook the market. This is the dot-com bubble. And before the dot-com bubble, everybody would just wake up, buy a stock, sell it at the end of the day, or just keep it, and then this came, and a lot of the gains that from amateur traders, from retail traders, all the profits that have been accumulated within this segment were quickly, given back. So there was a lesson there. Then it created the low in February 2023, and then we started to move back up again, once again into 2007, into summer of 2007. But if you look at this is the financial crisis. But if you literally look at the technical chart, what do we have? We have a double bottom, and we have a double bottom, and we have a double top. Nothing else than a range. So you treat it as a range, right? So if you look at a range, this is the breakout point from the range. This is actually when the quantitative easing has started. So it started, once the breakout happened, it started to go higher. This right here is 2016. This is the year before election, before we had election in 2016 in November. This is the November breakout. We had the volatility here with the trade wars, right? So here we can see the volatility. And back here, you can see the volatility that came out from the pandemic. It was the Black Swan event. But if you take a step back, it's like when you go to a museum and when you're looking like at a Rembrandt and you have a really large painting, you got to step back. You don't want to step very closely so you can watch all the brush strokes. You want to go back and see the whole picture. And this is exactly the whole picture of the market. So from this point on, we rallied, right? We saw that the market recovered really well. The tech sector was performing within this period of time. And then we had the pullback. And again, like I said, watch not the brush strokes, but watch the general dynamics of the market. We see one thing in common. The price action has rotated and has reversed off of this 50 simple moving average back in 2020. Back in December of 2019, because 2018 was actually the start. Right here was the start of the volatility. So this was the shake and bake right here, and was the start of volatility. The price action came to revisit the 50 simple moving average before actually moving higher again. So we see that there's this really certain dynamic around the 50 simple moving average, which becomes predictive. So don't be afraid to step back and look and see what the heck happened back into the chart, because that's going to be really reflective of where the price may be going, right? So now that we have this macro look and we see that we have this really big time frame, we have these monthly charts that are pointing higher, and they proved that they can assure a continuation for price action. Of course, we have to be very diligent, but now's the time. And I do this every single day. Of course, I don't take that much in explaining to myself what happens, but I just look at the technical chart to look for these continuation points. And then the next thing that I do, I look at the weekly charts and I look for the same things. I look for synchronicity moves. I look for similarities within price action in the past, because the past is always predictable. And when you're looking at trading, you're basically looking at things that, and you're looking at areas where things happen. So the happening places. All right, 200 simple moving average. Also, this is a double bottom formation, even though it went a little bit steeper. That's normal because it's the volatility, but it's still the support zone. And we can see here that the price action is going a little bit higher. Now, what we notice here is that we have a downtrend. This is confirmed downtrend. However, if you're looking at a monthly chart is not in a downtrend. The monthly chart is very well in an uptrend, but as we're stepping down into a smaller time frame, we're seeing that this weekly chart has developed a downtrend because it has a high, it has two lower highs, it has about three or four lower lows in here, but it's also hitting a massive level of support that is deriving not only from a prior pivot low, but is deriving from prior price action and from a 200 simple moving average, which is a really big deal for any kind of technical charts. In general, investors are very keen into following the 200 simple moving average, because the 200 simple moving average is seen as some kind of a guide. So anything that trades above should be bullish or should be bought. Anything that trades below should be bearish and should be sold. So for this reason, we're kind of challenging the top of the descending trend line. So if I was here to draw, let's see if I could do that. If I would draw a trend line, for example, let's see, nope. Oh, I can't draw for some reason. All right. Oh, here we go. If I was to draw a trend line, you can see here that we are into a massive inflection point. We have this is the first lower high. This is the second lower high. And we're at an inflection point where we really don't know what is going to happen here. Because if the price is going to start punching higher, and it's going to go a little bit higher here or a little bit higher, any kind of pullback is going to be viable. And this way, we're going to change the trend back again. So we're going to see if this is going to be the case or not. But the most serious thing that I'm looking at in the market is that we're hitting this inflection point right here. So this is going to be the big question mark when it comes to swing trades, because I swing trade, invest, and I also day trade into the market. So when we're looking, for example, on the daily, because we want to zoom in on some kind of technical formation for a day trade, for example. This is how I prepare in the morning. I look at the daily charts. These are going to be my go-to. And I look at the daily charts, I look at formations, and I look at everything that has been going on here on this chart. So definitely here, we have been struggling with this downtrend, right? So we have the high, we have the lower high, we have the lower high, we have the lower lows as well. So we have a really big downtrend development. But here yesterday, through the news that came out, we had the first punch above this 200 simple moving average, and of course above this trend line. That was a very big deal. The last time we revisited the 200 simple moving average, price got rejected. It was sent back down. And here as well, and this was earlier in the year, this was in March, price came into the top of the trend line, and then here got rejected from the 200 simple moving average as well. So we have to wait and see, is this a peekaboo high and a repeat of what we had in spring, and just a peekaboo high and then the price action is going to fail back, or is this going to stick, and is this going to carry the price higher? So now we have to go by all the technical data that we have in order to kind of like assess what is going on in the market. So one thing that I've noticed here is that we have started an uptrend onto the daily. So remember that we have uptrend on the monthly. Now we have a confirmed uptrend onto the daily because we have the bottom, we have two higher highs, we have two confirmed big higher lows right here, and we're getting ready to break above that specific trend line. So that puts us in bullish territory. So once I saw the bottom in, we quickly assessed the higher lows, and we were bullish throughout. And in fact, yesterday we wrapped up trading just before Powell spoke, and definitely this is something that we have discussed, and you had a question of me for me and how to trade news tomorrow, because there are some numbers that are coming out. I don't trade news. I definitely stay away from news. I don't touch news. I wait for the market about 30 minutes to an hour to digest the news, and then I'm going back into the market just to have that fleecing go away. All right, so here we have a nice staircase, and we have a breakout above this 200 SMA. So from this point on, I think that we're possibly going to challenge this high right here in well above 4,200. So let's say 42 to 4,200 to 4,250. So this is how I'm what I'm looking into the market. And for example, when I want to dive in and get into my day trade, so here is where I'm getting my bullish bias. So for the trading session today, I'm going to be bullish. Then I zoom in on my 1 hour. So I'm going into baby steps. Now, because I had a big move that happened in the overnight trading session, how do we know how to trade this? Well, definitely I have my moving averages as guides, but I also have my support and resistance area. So this is going to be a big support area that I'm going to have. And this is deriving from a prior high. So in an uptrend, this represents a minor support. So basically this is going to be the happening place. So if we're going to get a pullback very close to this area, this is going to be a buy zone. But again, I don't buy right on support. I buy confirmation from the technical pattern. So I look for buy setups, I look for sell setups, I look for breakouts, anything that will point me into a confirmation of the trend. However, the price action, and sometimes, the price doesn't, go as we plan for it. And for example, if it's going to be very strong, it's going to remain into these highs right off the open. I look at the overnight lows, I look at the overnight highs, and I look for any kind of technical pattern that will point me to the upside. So here I have a really nice rooting out off of the 10 exponential moving average. And I'm also seeing that the price action may start moving higher. So this is going to be my target, for example, if I were to take a trade right now. So if once I'm done with the analysis for the hourly chart, I'm diving into my favorite time frame, and this is the 5-minute time, the 5-minute charts, the 5-minute time frame, and that is because when you're trading, for example, a 1 minute or a 2 minute or even a tick chart, there are some traders that are trading tick charts. You don't have a lot of reaction time and analyzing appropriately the highs, the lows, the trigger points, the targets. So it's just a matter of impulse when you're trading the 1 minute or the 2 minute. I like to be, because I run a trading room as well, so we have hundreds of traders that are trading with us. I want to do all my homework and make sure that if they want to see how I trade, I want to go to a time frame that will allow me to show exactly what I'm looking at and to show my entry points, to show my stop points before they actually happen, and analyze the trade. I have the targets all set before anything happens. So in this example right here, so we have like a small grind that is happening. We do have this high. So basically you would go for the closest support level, which is, let's say 40.74, and you would go for a breakout here, let's say above the 80, and you would try to go for a target into the, let's say, into the 87 and into this top of the range, basically very close to 4100 that we tapped into yesterday's trading session. So this would be the homework. So I go from a higher time frame to a smaller time frame, and I try to identify patterns that are developing on my 5-minute chart if I'm a day trader. If I'm a swing trader, for example, I just stop at the daily, or I stop at the weekly. So it depends on what kind of swing trade I have. Sometimes I go, if I'm looking for overnight trades, I look at the 4-hour charts, and 4-hour charts are so representative because, for example, as we're getting closer, we have about 2.5 hours as we're getting into the New York trading session open. And I don't trade the overnight price action. I'm usually sleeping at this time. I'm getting up I'm a late riser, so I usually get up at around 8 o'clock. I get ready for the market. So I don't even look at the market at this time because there can be a lot of fake moves, and plus around 8:30 you have data, so I want to try to stay away from it. I'm usually having my breakfast around 8:30 when the data is coming in. I don't even look at charts because I don't care. I just look at the charts after the fact to see the reaction. So I trade the reaction and I don't trade the news. So this is how I analyze my macro to micro time frames before I get into a day trade, or if I get into a swing trade.
All right, so that's a very in-depth analysis for your trading. Basically, you've taken us from the higher time frames all the way back and even before that, your macro perspective, because most of the traders usually tend, especially at the beginning stages, they tend to overlook the macro elements. And they tend to say that, you know, maybe the fundamentals really don't matter that much, but it's important to have like a whole market overview and to be able to understand the macros as well as the micros for how you're trading and up to the execution stage. So I think Kish, you have a question. You had another question.
Yeah.
Yeah, and be audible.
So how do you adjust to the ever-changing financial markets?
Well, just by zooming in and out of time frames, I always go with the dominant trend. So for example, if I have higher time frames that are pointing higher, I don't want to be the one that is going against trend on a smaller time frame. So what I do is, because I'm a trend follower and a trend trader, I look for a pullback on a smaller time frame, and I don't short the pullbacks because the velocity of the move is always going to be to the upper side. And I'm glad you asked that, because in yesterday's trading session, and in fact, I could show you guys something that was very interesting that happened through this market. We have been having this sideways range for such a long time. And yesterday we had a level here at 39.91, which was pullback and rotation that came in. And obviously before before Powell was speaking and the market took off, we were trading somewhere over here. So I was telling everybody in the room that I'm not going to short, even though my bias is sideways. My bias is sideways towards moderate bullish because of the uptrend that we're confirming onto the daily, because we have the bottom, we have the higher low, we have the second higher low. This is the third higher low, but it was only confirmed when we were all done trading, but we were still looking for the upside. We had a big level here into the 92 for the rotation. For traders that trade the afternoon, I gave them that level as a bullish above level. And that was throughout the indices, because we had a nice 1, 2, 3 pullback into the 10 EMA. The 10 EMA just shows just a very dynamic trend following. This is a super trend. Anything that trades above the 10 EMA is a super trend. So once you have that on a, for example, a higher time frame, then you're not going to, go, for example, on a 5-minute chart, even throughout yesterday's trading session, which was look at yesterday's trading session, was a big mess, but we took advantage of this move right here to the upside. Because we're trend following, and we knew that, we knew that we wanted to trade to the upside because we didn't want to short. And I said, for me, shorting is not going to be an option here, because look how painful the short was. Did it work? Yes, it did. And it had for example, from this breakdown, it went all the way, let's say, from 39.56 to 39.48. So you could have captured, let's say, from 56 to about 53. So about 3 points. Rather here, where you could have called, let's say, from 52 to about 60 to 62, 10 points. So the velocity is always to the upside. So that's how, I try to stay on the right side of the trade by respecting the higher time frame.
All right, and Anka, there's a participant who's asking, Travis is asking, if at any one point you normally do back testing for your trades and how you do that.
I never done back testing, even when I was learning how to day trade, when I was learning how to trade, never back tested. You got to put your skin in the game and trade what's in front of you. Don't back test. Just look, have a strategy, work on that strategy in real time market. I think one of the key elements here is to keep on trading and keep a journal, because that's your back test. And don't waste your time with what happened, shoulda, coulda, woulda. No, just focus on what's in front of you right now. Never look back. Yes, you look back at the technical charts to get your technical levels. But I think the most important thing is to keep a journal. Have a really, really detailed journal where you're going to write down the date, You're going to write down the timing when you took the trade. Timing is very important because you would see that you perform better certain times of the day and you perform worse in certain times of the day. So for example, I don't trade doldrums, right, around lunchtime, and for a simple reason. When I first started trading, I kept a record of my trades that were during doldrums, and I didn't have a really high success rate. So why bother, and insisting in something that is not working for you? The other thing that you need to have in your journal, for example, is to have the symbol, to have the directional bias, to have the entry price, the stop price, to have the targets, to have your exit price, obviously, to have your percentage gain, and then have a column with the comments. And within that column, you need to point out what happened when you were, for example, if you stopped out. Why did you stop out? Was it news that stopped you out? Because that's a quick fix. You just eliminate trading news if news is not working for you. But keep at it for about 3 months, because remember, trading is not a marathon and takes time, and you have to go through a full cycle. So you have to go through a full earnings season, because earnings season is definitely impacting. You got to go through a full news, let's say, season as well, because you're getting FOMC meetings, you're getting unemployment claims, you're getting different numbers that are coming out. So 1 month is not representative, but track your trades for 3 months, draw a line and say, hey, this worked for me, this not work for me. So much better than back testing, in my point of view.
Yeah. And then Patrick is asking, but I think you've already captured this when you were doing your macro analysis. So he's asking, do you make use of supply and demand zones?
I do. Yes.
Which is captured in the price, essentially, which is what you took us through.
Exactly. I do take, so I could give a really quick example. This is an hourly chart, right? So you have to pay attention at support levels, but I don't buy at support levels. So because the support level is just the last shelf right before a breakdown, right? If you think about it, if the price action would have went on the other side, you could have, the price action here, if Powell hasn't, if Powell was not commenting on something positive, right, then the market would have interpreted it as bad, and therefore we would have broken down. So I go by patterns. So for example, this to me is a rotational pattern on the 1 hour that is definitely going to impact. So, the continuation of patterns. So I trade confirmation. So double bottom, breakout, higher, or double bottom, breakdown. So I keep it fairly simple, but yes, I do pay attention to support resistance areas. And in fact, I do pay attention to 8 layers of price support resistance before I take my trades.
All right, so we'll move to a fun type of questions now. Maybe you can tell us the most memorable trade that you've ever had since your trading career, which has spanned over 2 decades now.
Yeah, more than 2 decades. So I can't say about a memorable trade. I know I have been receiving this question before. A memorable trade should be all of the trades should be memorable. Why? Because all the trades should be in sync with your plan and should not be a surprise, because you're a technical trader. And a memorable trader is a trade not only that respected the plan, but respected the risk level. So once you respect your risk level, keep the risk the same, position size for your risk, then you're going to have memorable trades. Always, even the ones that you stop out of, because they're going to be, probably, and yes, any trader, even I have, stop outs, but my stop outs are far, or just a few compared to my winning trades. But as a memorable trade, like I said, memorable to me is a trade that most of the time it follows my plan, and you have to follow your plan. Just have a trading plan. It doesn't have to be big. It could fit like on a little post-it. But say, hey, if I'm a trend trader, I have to trade with the trend. I'm not going to shorting pullbacks. I'm just going to wait for pullbacks. That's what I do. I take very few trades. I take from 1 to 3 trades a day. Sometimes I may take, let's say, 5 trades in a day, and in certain cases, but most of the time, you're going to see that, throughout my portfolio, I have my transparent portfolio on my website. You're going to see that I don't take more than 1 trade a day. It's one and done. Grab your paycheck and run. That's what it's all about. And again, when you get into the market, this is very important. When you get into the market, every morning, you analyze your trades. Don't tell yourself, oh, I got to make money today. I have to make money today. No, tell yourself, I have to find the best possible setup today. And once you have that, because that's your job is to find the best setup that you can trade. Money's just going to follow. So it's a switch of mentality.
All right. Travis is asking if you accommodate any form of discretion in your trading plan.
No.
Okay. Okay. And then because you started out in banking and you have seen the markets react to different types of black swans, for example, the most recent one, COVID-19, we had the global recession of 2008, and every other black swan events that you have experienced so far. How different is it now that you're trading your own account as a swing trader and day trader than when it was as an institutional trader?
It is a huge difference because, first of all, it's your money, it's your savings. And when I came into them, I was always an investor and a swing trader. But about 20 years ago, when I made the switch to day trading, it was a totally different ball game. So just like everybody else, I needed to get the trading education for day trading because it's so much different. It's such a rapid price action compared to swing trading, right? When you're swing trading, you're holding positions from 2 days to about 2 weeks or so. And when you're investing, you can hold positions for a couple of years to decades. But when you're day trading, you're in and out within the same day. That is your income producing method. And swing trading and investing is basically your wealth accumulation, your wealth generation stage. So yeah, it's very different. You have to adjust, especially with your size. You have to adjust, and I had to adjust with a lot of things, and I needed a lot of help for that. I had tons of mentoring. I took all the courses that I could, and back 20 years ago, we didn't have Zoom meetings. So I think there was a chat room back then. It was a .com. I think they're still around today, but they're not as popular. But if you wanted to, find out more about trading, you had to travel to different destinations. So yeah, I was like, I was traveling. I was going to New York. I was going to Florida. I was going to Vegas just to find out more information and to get in touch with other day traders to see what's working for them. And then again, you have to find your sweet spot and apply what do you have learned? For me, it was a little bit easier because I already had the basic concepts of risk that I took very, very seriously from day one because I knew how to apply the risk. That is something that you do whether you have a small account or a big account or a 2 comma account or more. But definitely the one thing that boils down to is that you need to have the trading education for the specific trading style that you're adopting. So it depends whether you want to be an income producer. I'm both. So I'm an income. I generate income through my day trading of the indices. I call them my employees. My 4 indices are my employees. Those are my go-to. And yes, for swing trading is for wealth accumulation. You're keeping the money in the market for a little bit longer time. So you can't access that right at the end of the month. And at the end of the month, I pull my money out of my account and I start with zero back again. But if you want to grow your account, just keep your money in the account until you have the desired amount that where you can achieve grabbing your paychecks from the market.
All right. So it's interesting to know that you can be both a day trader and a swing trader, and your trading approach, it's very simplistic. You just go for one trade every day, you make your money and you're out. So I think we can have 2 more questions from Kish, and then look at participants if they have questions.
Of course.
Okay.
Yeah.
So do you get emotional about your trades? And
Ooh, oh my gosh, this is a great question. Thank you. Yes, you get emotional. And I think that emotions help because they help you navigate through the trade and as women, I think that we have that extra sense that danger sense that is keeping us on the right side. I find that women traders are so much more careful about their trades, about their risk than any trader that I have met. And I think, of course, you get emotional, and especially if you're making mistakes, because hey, don't think that if somebody has been trading for 20 years or 15 years or 10 years, they're not going to be making mistakes. Yes, you do. So for example, things happen very quickly in a live market environment. So when you position size, for example, and when you evaluate your risk, you position size, and sometimes mistakes happen. Sometimes you may get in with a bit more size than you wanted into that trade because you had to take that decision so quickly. And then yes, the emotions are running high. Running very high when you're, for example, having more size to your trade. So yeah, I think emotions are good, are keeping us in check into the market, and there's no way to eliminate emotion. So we're dealing with the most precious commodity in the world, which is money. And you cannot separate emotions from trading. I know there are, so many trader psychologists out there that say, hey, you have to separate. No, you can't. It's your money. Okay. It's your money. It's your living. You can't separate. So yeah, you are going to have to, you have to deal with the emotions, but not all the time, because if you have a trading plan, and for example, I run a trading room every single day, and I have so many traders that are in the room, I don't think they're sensing any kind of emotion on my side. It's actually a stress-free trading in a stress-free environment, because as long as you're following your plan, and as soon as you realize that navigating away from a very tight time frame, which is a 1 minute or a 2 minute, and going towards a 5 minute, you're eliminating those emotions. Why? Because you can take that decision. You're allowing yourself a little bit more time for that decision. And I think that's going to help being less emotional in trading. You cannot separate emotions, but you can keep them in check and keep them at a minimum.
Okay. And what are some of the mistakes you've made in your trading career?
It should happen that, sometimes you're oversizing just because everything is happening so fast. And I think that's one of the most common mistakes. But other than that, of course, when you look at a trade, you say, okay, yeah, I should have taken partial profits here versus holding the whole entire trade. So I think every trade is different with, each trade may have its own mistakes. But I did have some really good practices from my mentors when I started trading, just to eliminate these kinds of mistakes. And once you have a trading plan, you're going to see that you're going to stick to your plan. So for example, if your plan says, hey, I'm going to sell half into target 1, if you decide to keep the trade based on price action or what the case may be, that's up to you. But it's always a great idea to start trailing, to start easing out, so you don't carry the whole burden of the whole entire size.
Mm-hmm. And pre-COVID, you used to have like trading boot camps where you'd organize like a bunch of traders and you guys would meet. You'd also like invite other traders like Stephanie and your couple of friends. And do you know now post-COVID, since Zoom has like made the world come into one smaller village, do you have those trading boot camps? How do people sign up, for example, for your live trading rooms? And if they want to be part of your trading network, for example, like this session that we've done today, which we truly appreciate you for your time.
Oh,
at
Sylvia,
zero
thank you so
cost.
much.
Yeah.
Well, we haven't done any live boot camps like we used to, and I think everybody is, a little bit more reserved still. But we have been online all the time. We have been doing these online events so often. We do them every month with traders around the world, and it's been fun connecting, and I think Zoom has been incredible. I have been running, so I'm very familiar to these rooms even before COVID, but now everybody is so comfortable. You can come trade in a pajama, okay, or you can attend a session and sweatpants. So yeah, we have been organizing these events. I have, and I'm in touch with my traders every single day because I trade live and I share my charts. I share what I'm looking at in the markets every day. And I do trade from 9 o'clock until about 11 to 11:30 every single day. You can find me at tradeoutloud.com under services. You guys can see what I'm offering, and also we do offer education as well, so you can visit the education tab. We do provide education for day trading, for swing trading, for stocks, for futures, for pretty much everything under the sun.
All right. I think that's all the time we had for today. Thank you so much, Anka. Of course, we'd love to host you again next year and the years to come. So we also thank the participants for being here today. I think everybody has taken a lesson or two, especially on the practical side of your trading. We thank you so much, and we'll see you next time.
Thank you so much, Sylvia, for having me. Thank you, everybody, for being here today. Looking forward to seeing you soon. And Happy New Year, right? Because we're in December.
Yeah, enjoy the festive season, family time.
Enjoy the holidays, everybody. Yes.
All right, bye.
Thank you. Bye.
Mm.